Hey, this is going to be a pretty deep dive into real estate investing, and if you really like a deep and thoughtful, thought-provoking information about finance, use that coupon code expiring tonight. That price is going to go up. We're changing it this weekend. Prices are going to move up, and we are totally removing lifetime access for some folks who don't get in with that coupon code linked down below. So make sure if you get in using that coupon code linked down below, if it still works when you try it, you're going to lock in lifetime access to the programs on Building Your Wealth. So use that code linked down below. We are changing all that information this weekend, so take advantage of that. Link down below. Do it right now. Just open it up while you listen to this. This is going to be a really good dive into real estate. Buckle up. I hope you enjoy it because you're going to learn a lot. Hey, so I think it's useful to have a real talk discussion about the real estate market and some expectations here because there are a lot of folks who are claiming that real estate is basically going to collapse the entire world, and I actually don't think that is true. I don't think we're going to see a 2008 style collapse. Now, I do want to be very clear that real estate prices, I expect, are going to continue to come down. And we're going to go through a version of the real estate cycle, which we're going to talk about here in a moment. But these beliefs that rents are going to collapse and therefore prices are going to collapse and then wealth is going to collapse and then the economy is going to collapse, I think there are a lot of these that are substantially overblown. And so without overwhelming you with like too much in the way of granular data, I just wanted to have a simple discussion with you about at least my thoughts on the real estate market and what's to come and maybe how to plan for this real estate market transition, I think we ought to call it. So first, it's worth noting that I have been studying what I call the real estate cycle, which is actually on screen right here now. I've been studying this real estate cycle, which I created this graphic back in Photoshop back in like 2010. I was inspired by other people's real estate cycle graphics, but these particular arrows and colors are mine. And the reason for that is I made this because I printed this out in a very large frame that I would bring to open houses because it was a conversation starter. Remember, I was a real estate broker. I still am a real estate broker, but I don't actively help people buy and sell homes anymore. So I would hold open houses and I would set this up in the kitchen and people would walk in and go, "So, where are we in the cycle now?" And I have always been a student of the Fed and market cycles and booms and busts, and I think it's so incredibly fascinating. And so I think it's useful to understand, when do rents go up? When do rents go down? When do prices go up? When do prices come down, right? And all of this really fits in the real estate cycle. And it's really incredible because the cycle just means you're going to hit a low and then you start going up again, right? And generally, the way America works, and thanks to inflationary dynamics, generally, when we go through the real estate cycle, think of it kind of like a snowball in reverse. So it's kind of like going uphill, which is kind of interesting because every time you go through the cycle, your previous low tends to be lower than the next low, which is nice because that means you sort of have this longer term appreciation for real estate. So do I actually think we're going to revisit prices of 2008? No, not even remotely close. Do I even think we're going to revisit prices of 2000? The real estate, certainly not the bottom in 2011, but even like 2014 or 15, probably not. You know, if we have a real estate price correction to valuations maybe slightly overcorrected to 2017-18 levels, that's probably the extent of which we might see a real estate correction here. Now, there's some factors that go into this, and we'll talk about these. So let's look at this cycle in detail here. So I'll take a little screenshot of this, and we're gonna blow it up, and we'll go through this cycle in detail here because there's a lot of drama around this, and I think it's worth you having some clarity because then I think we're gonna be able to see, okay, like when do we make profit, and how do we make that profit, and when do we have to be really fearful, right? So the first thing about when we have to be fearful, let's start there because that's really gonna help us time this out, is we know that somewhere between February and June, most markets hit a peak. This is approximately when the real estate market hit a peak, is somewhere between February and June in most markets. So most markets have already seen an inflection point in the pricing of real estate. And we measure that by looking at the month-over-month sales activity. If 1 month homes are selling for $100,000, and the next month they're selling for $95,000, then we know prices went down 5% that month. Generally, we don't see large declines like that. The average decline that we saw during the Great Recession was somewhere around 1.9% per month. And right now, we're actually starting to see some 2% month-over-month declines in areas like Seattle, San Francisco, San Diego, Idaho, Austin, Texas, so on, Boise, Idaho specifically. But the year-over-year numbers are still higher. And so when we look at that, that's simply logical, because when we look at a year ago, so let's say this is, for example, let's make this a little more clear. Let's say these two dots right here are September, so right here is September 22, and then this over here is Sep 21. Well, visually, it's worth considering that maybe prices are at 95K here, down from that 100K we had before, but that might still be higher than the, say, 90,000 we had here. So it'd be somewhere around, what, 5.5% higher. So you still have that year-over-year growth. Okay, worth noting. So when do we actually have a fear moment and a fear catalyst that comes into this market? Well, in my opinion, it's when we actually get to where prices have come down and year over year. So let's say, in this case, March to March. And the reason I'm picking March is because let's say prices peaked in March over here. Then actually we'd probably be better off drawing it like this. Watch this. So if prices peaked over here in March in an area, and now we get to March of the next year here. Well, now this is where you're really going to see that year-over-year decline in pricing, and you might see something scary like -10 or -15%. And I think this is really when you get that Tucker Carlson and CNN and Anderson Cooper kind of clickbait where it's like, oh my gosh, home prices finally fall year-over-year for the first time in 15 years or whatever, blah, blah, blah. We're gonna get that sort of drama. And that drama can feed upon itself, unfortunately, because that could lead some folks to sell homes who otherwise might not want to sell homes because they've locked in a low interest rate and they're better off staying. And so a lot of folks ask me, like, why would somebody sell if they have a low interest rate? That doesn't make sense. Like, why wouldn't they just stay and just wait and hodl, right? Well, it's important to remember that 80-year-olds own twice as much real estate as like a 35-year-old. Even 70-year-olds statistically own twice as much real estate as a 35-year-old. So your odds of home ownership are a lot higher the older you get. And there are a lot of individuals who are in retirement or are retiring who say, you know what, I don't want to go through another real estate cycle. I don't have the time to go through another cycle. I'm going to sell and downsize now, maybe into something smaller. Or I'm going to sell all my rental properties that have been hodling. I'm going to dump those now, maybe at more of a closer to peak pricing than maybe what I'll be able to get in the future, especially as interest rates continue to rise. Remember, the cycle correction that we're going through right now is driven, like this inflection point, is driven by nothing other than the Federal Reserve. Like, we have a lack of homes. There are not enough homes. We expect that excess demand for homes before the Federal Reserve started tightening was somewhere around 25%. Even Lowe's studied this in their earnings call. They thought that excess demand was somewhere around 25%. But the problem is, when interest rates are 2.5% for a 30-year fixed rate mortgage, and now let's say they're 7% for a 30-year fixed rate mortgage, that's a difference, a delta here of 4%. And a difference of 4.5%, a delta of 4.5% represents a 45% decline in purchasing power. So now if you offset that excess demand and lack of supply we had with that negative 45% drop in purchasing power, you could see a negative 20% decline in prices. And that would take us to roughly, maybe a year before pre-COVID levels, or maybe slightly before pre-COVID. So you're talking end of 2019 kind of pricing, right? So this is what has inspired this sort of inflection point here. And so even though we have a shortage of listings, it's very important to consider buyer purchasing power as something that is slowing this. And so now if we couple this together with the fear of potentially, oh no, we are seeing year-over-year declines in prices, we can exacerbate the real estate fall thanks to fear of loss and fear of having to go through another cycle and potentially overcorrect real estate prices to the downside. My guess would be somewhere up to potentially 30%. Some markets we might see a little bit more. Now, do I think we're going to see something like a 2008 style recession because of no income, no job, no asset, ninja loans, or dead people getting loans, or people with terrible credit scores getting loans? No, I don't think we're going to see a 2008 style recession for the real estate market, especially since credit scores today are about 100 points on average higher than they were back then. You're talking about 780 instead of 680, and you're talking about people who really have the ability to repay their loans. So you're going to have a lot more of this sort of discretionary selling where people say, well, I'm going to get rid of my investment properties, or I'm going to downsize earlier, right? But there's another potential push towards discretionary selling, and that is going to come from pension funds. Pension funds and asset managers who say, look, we don't know how to buy wedge deals. We don't even know how to renovate properties. We just buy and hodl real estate. And we just milk the cash on cash return. Excuse me. And the cash on cash return on some real estate in the country is like 3 to 5%. Well, some pension funds are going to look at that and they're going to say, well, why do we deal with tenants and toilets for 3 to 5%? Let's just dump those and try to either feed our margin calls that we're suffering in the stock market or in the bond market, or just go buy the dip in the stock or the bond market, and we'll liquidate some of the real estate that we own, and we'll go buy the dip in stocks or bonds or whatever, or just buy treasury bonds at 4 to 5% yields. Like, why bother dealing with tenants and toilets when you can get a 4% treasury risk free? And that, combined with liquidity pressures and margin calls, you're probably going to see some pension funds and institutions start liquidating properties. So what's fascinating about this is you are going to, the more the Fed tightens, you are going to drive people to sell. Now, in the short term, you have this really weird phenomenon where rent prices can actually go up as home prices fall, but that does not last forever. I want to make that very clear. Like, at some point, that transitions and rents do end up falling. But rents end up falling later, and you'll actually see that in my real estate cycle as well. And that's because of a concept known as inertial inflation. And so even though it's easy right now to go into like an Austin, Texas, or Miami, or Boise, or Phoenix, Arizona, and pull up charts about how rents are falling in those areas, well, that's a duh, because you have a reversal of some of the COVID trends that you used to have, right? So you're going to have kind of like an earnings recession, so to speak. You're going to have a hard comparison to last year because boom and zoom towns are now no more. But nationwide, we're still seeing rents rise. In fact, Morgan Stanley expects rents to rise 3.5% in 2023. You've got Bloomberg Intelligence that did an analysis on about 10 different rates, and they expect the average rental increase and rental growth to be between 2 to 4% over the next year between all of those different real estate investment trusts. So you're really not seeing this mass panic yet in terms of rents falling. And again, that's usually because you have a lag of rental declines, and that's pretty typical. The reason you see that is because housing purchasing is very interest rate sensitive. As soon as interest rates for homes go up, purchasing power goes down almost simultaneously. It's almost instant. That can, in the short term, drive some more people to actually rent properties and drive up rent in high demand areas. And this is where things get a little bit convoluted and complicated, but I'm going to keep it as simple as possible. Think about the rent curve like this. As home prices go down, you could actually see real estate rents go up. And so you kind of get this like double top here. The orange line being prices and then rents. Rents do end up tending to follow down because now the costs of mortgages goes down. The cost of buying, let's say, a rental property is way lower over here. And that means you could bring more supply to market. So more people buy homes cheaper, more rental supply comes to the market. For example, my company HouseHack comes in and buys 200 homes or whatever in a couple different markets or 3 different markets, whatever. And now we put this up for rent. Well, now we are providing more supply of housing for people that's renovated and healthy and safe to move into, right? And so rents could come down a little bit. So you want to price in these sorts of buffers. This is very typical, and this is where you get this sort of double top shape. But the rent inertial, like the inertial inflation first pushes up rents for a while, maybe in a 6 to 12 months of rents still moving up, and then rents will come down. So you have to prepare for that in the real estate market. You have to prepare for this sort of transition that's going to come to the downside in rents. Because of what I've just described. But what's really remarkable and that I really love is that people forget, and the part that I love is not that this happens, but that people forget this. People forget that real estate is about desirability, right? People want to live in areas that are desirable. That will generally help prop up prices and rents to a certain level. However, the opposite is true of areas that are not necessarily uniquely desirable. For example, if you're in a particular town where the weather consistently year-round is between 90 and 110 degrees, you really have few natural resources or amenities near you. Maybe you're in a desert or whatever, or the amenities and resources that are around you are not ones that are desirable to you, certainly not desirable for human habitability, then you might leave. Maybe you moved to that area because state income taxes were lower, or it was, the housing was initially cheaper, but then it became expensive, right? But what happens in areas like this is people move to them during these sorts of pandemics or life-changing events like tax events that change or whatever. And they realize, wait a minute, I don't actually want to live here, and they potentially leave. So you sometimes have this transition away from areas, and you can actually see declining rents sooner in potentially less desirable areas. So I would say that this curve looks a lot more like this. I'll give it a little bit more of a gap. Looks a lot more like this in low desirability areas. So if orange is prices, green is desirability areas, and you see those rents fall sooner, and red is going to be that decline in rents in higher desirability areas. You're probably still going to see those declines, but the magnitude of the declines or the length of those declines could occur longer. You might get an earlier bottom in some of the more desirable areas. And this actually is where we get into a new concept, which is quite remarkable, and it's known as the concentration of poverty. And see, the concentration of poverty concept is incredible, and it's very important to understand. So I'm going to give an example here. Let's say you live on the coast of California and you can't afford living in the coast of California anymore, and now you're going to move inland. And I'm not going to pick an example of a town inland, but let's say you're going to move inland to California because you just can't afford living on the coast anymore. Well, you and many others make that same move inland, and now you go to a small town of, say, 30,000 people. And you move from a larger city on the coast that was very expensive to a low cost of living area where there are 30,000 people. But now all of a sudden you get this rapid growth in population from 30,000 to, say, 36,000. So now all of a sudden population grew 20% in this area. And initially you get rents that boom up. Maybe that's what happened during the pandemic, right? You get rents that boom up. And they boom up so much and so quickly that it's actually an unsustainable rise, and then you actually start seeing something incredible happening, and that's known as a service decline because of the concentration of poverty. So you take people who can't afford living in expensive areas anymore, you move them to poorer areas, and now you overwhelm poorer infrastructure, schools, police, fire, street cleaning, roads, everything, stores, everything is now overwhelmed and overfilled. And you actually reduce the value of living in that now 36,000 town, 36 population town, because everything's actually worse than before those folks moved there. Now you have this really interesting curve that you want to think about, because really what you've done here is you had some form of a shock, or either a tax change or a pandemic or whatever, that led rents to artificially run up above the trajectory of sort of the nation, right? Like if the orange line is sort of national rents, for some reason this one particular area just exploded. But then all of a sudden, because of the concentration of poverty, it becomes actually overpopulated and less desirable to live here or raise children here. And you actually end up seeing a quicker decline here. And even though everywhere rents might slow, those areas that become concentrated for poverty can quickly actually become towns that could eventually go bankrupt, and you could see a substantial correction to the downside in rents. So this is where balancing desirability in real estate is so important, and this is where I want to give you sort of a roadmap for when you're thinking about real estate, is you have to think about real estate as what it is first. People have to want to live there. If you're simply looking at a spreadsheet and cash on cash returns, you could end up investing in a bankrupt town that has one source of jobs. And if that one source of jobs goes away, you're done. All those rental properties go to zero, or they're worthless, or people just leave and you can't rent them out anymore. And then you lose liquidity, right? Liquidity is something that's already not synonymous with real estate. Real estate is not known as being a liquid investment. But your investment will be more liquid if you invest in a desirable area. For example, I sold 85% of my real estate portfolio in an extremely desirable city, actually in multiple extremely desirable cities. And I was able to do so very quickly because there are plenty of people willing to buy, because there are more than 700,000 people in the county that I was selling these properties in. Well, if you're selling in a county that has 20,000 people and all of a sudden you've got to dump 20 or 50 properties, what are you going to do? The liquidity won't be there. So smaller towns have liquidity risk. They have this potential key employment risk. They have desirability risks. And so there are a lot of these Zoom towns that are actually going to see these massive declining rents very, very quickly, and potentially pension fund liquidations of properties to where, yeah, you could in isolated regions actually see prices fall substantially more than you might nationwide. And so this is where when people say all real estate is local, they're right. Like every market's going to behave differently. You can't like paint the whole market with a one big brush and say that's it. Everything's going down 30%. No. Do I think everything is going to trend down? Yes, absolutely. I think all real estate markets across the entire United States and probably the world are going to trend down under these higher interest rate regimes that we're facing. And we probably won't see a trough in real estate prices, like a bottom, until a year to a year and a half after the Federal Reserve finishes their tightening. That's kind of scary. But it all goes back to the real estate cycle. And what's fascinating is the real estate cycle actually teaches us about that delay in rents. But I wanted to, before we talked about the real estate cycle, just teach that real estate is local. Not only is real estate local, but you have this concentration of poverty risk and this Zoomtown issue that occurred that could lead you to see some dramatic changes to the downside in rents in some areas that are just not going to be true in others. So do keep that in mind. Inertial inflation first, then rents go down. How can we see that depicted here? Well, let's start here, which is, what does the bottom of the market look like? Well, the bottom of the market actually is very interesting. I remember this very, very clearly because I remember marking the bottom of the market in November of 2021. And the reason I was able to do that was because I saw housing inventory rise up to the point where the one city that I worked in had 450 properties on the market. When somebody came to me and said, Kevin, I want to buy a 3-bedroom, 2-bath house, I said, sure. Which neighborhood? Because there are 10 in each. It was incredible. And I remember at the time, we had about 450 properties on the market, and that was about November of 2011. And I began noticing that the number of properties on the market began falling. We went from 450 to 420 to 400 to 380 to 350. And before you knew it, by November of 2012, you won't believe this, we were down to 80 properties on the market. That's it. It got so bad that real estate agents were wondering, how am I going to be able to survive? There are not enough homes to sell. I remember this clearly. I'll never forget that. And sure enough, that next year, in March of 2013, we actually saw home prices jump about 20% in not the span of a year, but in the span of 2 months. It was April and it was March. So we saw this explosion in home prices very, very, very quickly because there were just so few homes. Somebody put a place up for $350, it'd sell for $400. So somebody else put a place up for $400 and then that'd sell for $450 until it found that equilibrium, right? So supply is such a clear indicator of a bottom in a market that tracking supply is probably the best thing that you can do. But notice that you get an absorption of real estate for sale supply before you actually get low tenant vacancies. And then when you get low tenant vacancies, you see increased rent and prices. Obviously, prices go up kind of through the whole curve here. Then you get sort of this glut of new construction. kind of what we got going on right now. We've got the most homes under construction right now that we've seen over the last decade. We have the most homes under construction now. And some of that has to do with supply chain, bottlenecks, and holdups and such, but there's a lot of new construction right now. And this is where then you start actually having the opposite effect, where you potentially go from a shortage of homes to an oversupply. And this is roughly where we sit right now, right? If we just hit, if March was 2022 was over here, we're just at the beginning of potentially even touching oversupply in some markets. But a lot of areas are still very, very low in supply. We're just in the trajectory of adding more homes on the market. So it's going to be a while before we're actually at saturation on the market, where there's so many for sale signs around that you're just like, oh my gosh, what's going on to this town? There's so many for sale signs around. Only after you get this oversupply and you start seeing prices actually come down, do you then start getting higher vacancies. And that's because people are moving out of potentially certain areas that they moved to for, again, Zoom purposes, and are now leaving. And now these places become harder to rent out. And because there's now an oversupply, you have potentially more sellers who are saying, oh, it's time for me to rent out my property instead of trying to sell it. And that leads to vacancies because they can't sell it, and now they can't rent it either. But only later do we actually get the full realization of declining prices on a year-over-year basis. Month-over-month begins a lot earlier. And declining rent in general tends to occur later in that bottoming process. It's kind of fascinating. I think it's not like a perfect cycle here. I think I could tell you that declining prices really start here, but you don't see those year-over-year moves over here. Same thing with increased prices, probably begin over here. So it'd probably be worth updating that to say declining prices here, increased prices over here. It's sort of the oranges, right? But those rents lag. You generally don't see those rents until vacancies change, and that's why the order of this cycle is so important. So the point of all of this is to first of all encourage you to be prepared, right? Get educated. I mean, y'all know I sell courses on this kind of stuff, but get educated. Watch YouTube videos. Go to my real estate playlist. You can go to metkevin.com/links, and the real estate playlist is on there. I will double check after I post this video. But you can click the real estate playlist and watch the real estate videos. metkevin.com/links. If you just want to watch Fed videos or stock videos, and click those links. You can do whatever you want. If you want to invest in house hack or learn about the courses, click those links. Just everything's at metkevin.com/links. But pay down debt. Get a better job. Somebody suggested the other day that they were going to get a second job. Like, they make 6 figures at one job, and they're like, I have so much free time, I'm just going to get a second job. And it's like, hey, well, if you can have 2 6-figure jobs, for example, I don't know. Even if you had a 6-figure job and a 50K job, it's like, well, now you're able to qualify for that much more real estate, right? Now you're probably going to need to do that for 2 years and prove that, or at least 1 year plus like some kind of year-to-date income statements, which some lenders will do, not all lenders will do. But get your income up. Now's the time, and I hate to say it, but it's true. Now's the time to double down. Tighten those bootstraps, save money, and see what you can really do to prepare yourself to buy real estate. Getting educated, paying down debt, having a lower debt to income, and having more cash available for a down payment and to qualify for a loan is what's going to get you into real estate. And so if I had to paint sort of a projection for the real estate market right now in terms of where I think top and bottom is, we'll do that together, and then we'll end the video, okay? I think this is actually quite useful. So we basically had this near straight up, certainly an acceleration, I'd say, in 2013. In 2018, we had a minor little dip here, and then in the COVID pandemic, we had a minor little dip. And then we went a little parabolic, and I'd say now we're turning, okay? So I'm going to make that turn a little bit more abrupt since I'm running out of space. So we're going to go with a turn here. So let's go ahead and label this. Let's call this 2011, 2013, 2018, 2020. Here's your pandemic boom time, right? Now here you sit at 2022. you're not going to go back to these sorts of levels all the way down on the left side, but I do think there's a chance you'll probably go somewhere over here. And so I would say we're going to compress this a little bit just so I can like graphically kind of show it to you. I would guess the real estate market will probably do something like this, where we do go back maybe to those 2019-ish levels, right? Yeah, I believe that this, we'll probably see a Fed U-turn. Probably if this is, I think you're going to see a more dramatic drop here in March of 23. You probably have a Fed U-turn here, and I'm going to go with Q4 2023. Oops, 2023. There we go, something like this. And then probably like a Q2 2024, maybe trough, bottom somewhere around here. Maybe even a little bit earlier. So like Q1 2024 to Q2. Like that winter quarter could be very interesting as well. So maybe even like Q4 23, something like that. So Fed U-turn, call that Q3 to Q4. Q3 to Q4 2023. Bottom somewhere between Q4 2023 and Q2 2024. But then it's going to take a little while to really get out of this, because I don't think rates are going to plummet very, very quickly, although they could, and they could drive the market up quickly. But I would say you'd certainly be back to some form of appreciation by 2025, Q1 almost certainly. But you can't make any guarantees. You know, these are just guesses, and all of these facts could change dramatically. So these are just my thoughts. Personally, with house hack, I probably want to be buying here, you know, as the market kind of is here. So I don't want to be buying now. This right here, this is wait. Patience, I think, will be rewarded. And so that's going to be a little bit of the goal for us. Anyway, hopefully that provides you some insight. If you found it helpful, consider sharing the video. Appreciate you as always, and we'll see you in the next one. Thanks. Goodbye.